Dan Davies, Lying for Money, How Legendary Frauds Reveal the Workings of the World. In Lying for Money, author Dan Davies offers an insightful look into the world of white-collar crime, revealing how these legendary frauds expose the hidden side of our global economic systems. The book examines the frameworks and mechanisms behind famous cases of deceit, uncovering the need for opportunistic exploitation of corporate and financial entities. Readers can expect captivating explorations into schemes such as the Ponzi scheme, the London Interbank Offered Rate, LIBOR, scandal, and the U.S. savings and loan crisis of the 1980s. The book aims to reveal the nature of fraud in the modern economy, where the desire for wealth surpasses legitimate means of obtaining it, and how an understanding of such crimes can grant powerful insights into our global economy.
The Art of Fraud, How It Works, From Ponzi Schemes to Financial Institutions. Fraud has increased concomitantly with the advancement of the global economy. It is an elusive crime that can subvert the usual checks and balances of a legitimate business. To deceive corporations or financial institutions, perpetrators must have a deep understanding of the business. Criminals who commit fiscal crimes are often of the same social status as those who prosecute them, which emphasizes the deep-seated problem of fraudulent activities in society. Pyramid schemes and other scams prey on the financially vulnerable, attaching themselves to affinity and religious groups in poor communities. Additionally, financial analysts discovered a major financial crime that caused banks such as LIBOR to pay millions of dollars in fines. Similarly, publicly traded companies, such as the City of London Convalescent Fund, Pension Society and Savings Bank, are not immune to fraudulent activities, as seen with the infamous John Stanley Humphrey. Accounting fraud is typically the foundation of stock market fraud. The stock market often exploits a company's potential rather than its actual profits. Despite the potential for fraud in the stock market, surprisingly little actually occurs due to due diligence measures. Long-firm frauds and Medicare scams. Commercial transactions are based on the principle that a seller will deliver goods and the buyer will pay for it. However, long-firm frauds occur when a fraudulent party runs up commercial credit with the intention of defaulting on it. In the 1960s, American Express was a victim of long-firm fraud when they lent money to Tino DeAngelis, who used vegetable oil as collateral. DeAngelis committed fraud by putting seawater in the oil vats instead of the promised oil. Similarly, in the late 1900s, fraudulent Medicare claims cost the system hundreds of billions of dollars due to weak internal mechanisms and lack of oversight. Perpetrators took advantage of this by billing the system for expensive, non-existent services. To avoid these scams, proper checks and balances need to be in place to prevent fraudulent activities. Counterfeiting beyond currency. Counterfeiting extends beyond paper bills to misrepresenting products, and can have fatal consequences, as demonstrated by the death of musician Prince caused by a counterfeit drug. Despite the efforts of pharmaceutical companies and regulators, the problem persists. Trust and certification are essential in the medical industry, amplifying the severity of counterfeit drugs. Frauds like these highlight the pervasiveness of counterfeiting and the need for increased vigilance. The rise and fall of Charles Keating. In the 1980s, the U.S. savings and loan (SNL) industry faced financial trouble due to limited mortgage options and insufficient scrutiny. Charles Keating took advantage of this situation by corrupting property appraisers and engaging in fraudulent activities. He grew his empire by manipulating market valuations and buying political influence, but eventually faced downfall when his misrepresentations were uncovered. The scandal highlighted the need for better financial oversight. The market crime of money laundering. Money laundering is a type of criminal activity that involves entire markets and is usually quite profitable, incorporating cartels and insider trading. A clear example is seen in the case of Clarence Saunders, the founder of retailer Piggly Wiggly, who introduced the concept of self-service supermarkets in the U.S. in the early 1900s. Despite owning the patents and name of Piggly Wiggly, investors could only purchase stock in Piggly Wiggly Stores Incorporated. When New York franchisees went bankrupt in 1922, investors were surprised to find out about the real ownership of the store chain, and this caused market turmoil. To rescue the situation, Saunders used his company's funds to buy shares in the Stores Corporation, causing a rise in prices and gaining the attention of the New York Stock Exchange. Saunders was found guilty of market manipulation and fraud. The global financial system has become a tool of law enforcement in tracking down such crimes, given its extensive prevalence. Fraud in government. The prevalence of fraud in government stems from the incompetence and scale of public sector organizations. Elected officials without specialized knowledge make crucial decisions, and their ability to enforce financial controls is questionable. Tax fraud is a global phenomenon, but regulators are acting to close tax loopholes. Criminals choose to launder their money to bypass banking system protections. They deposit cash derived from criminal activity into legitimate business accounts to spend or invest in assets. The penalties for money laundering are severe, and felons only need to fool enough people to get their money. The anatomy of fraud. Fraud is not just a financial crime, it is a complex problem that lurks in every corner of the modern economy. The three essential components of fraud include need, opportunity, and rationalization. Fraudsters can easily identify weaknesses in corporate and government control systems and exploit them for gains. The penalties for white-collar offenses are insufficient, and those in power are often lenient towards their own social class. Understanding the intricate workings of fraud helps us to safeguard ourselves from scams, pyramid schemes, and other illegitimate businesses that can rob us of our money and savings.
Ultimately, Lying for Money provides readers with a clear understanding of the various forms of fraud and their impact on both corporations and individuals. By delving deep into the cases of white-collar crime, Davies demonstrates how various elements of need, opportunity, and rationalization contribute to the rise of fraudulent activities. The penalties for these offenses often do not correspond to the damage they inflict due to social biases within the justice system. As the modern economy continues to develop, so will fraudulent practices, with criminals constantly searching for weaknesses to exploit. Recognizing and understanding the world of legendary frauds can not only help us protect ourselves from deceit, but also provide valuable insights into the workings of the global economy.